Hello, everyone. My name is Tooways Asmal. Welcome to another episode of Two Ways to Skin a Cat, a show where we talk career experiences, entrepreneurship, and investments. The main aim is to show that there's more than one way to be successful other than just climbing the corporate ladder. This is another surprise stream. I'm trying to see how this performance compared to those that have been pre scheduled. We are live on LinkedIn and YouTube, and the show will be available on podcast by tomorrow. So don't forget to like, subscribe, and click on that notification bell to get automatically notified when the next episode comes out. If you're joining me live, drop a one in the comments so that I know I'm not talking to myself. Well, I'm not talking to myself. Drop a two in the comments if you're watching the recording. So today I'll be talking about investing for professionals who don't work with investments on a day-to-day basis. Those who work with investments on a daily basis are working on their craft daily and they're working with very smart investment professionals. For the rest of us, we might not have access to those skills and might be intimidated about where to start. So, this discussion is maybe just a way to get you started or to get you back on track. A quick disclaimer: this is not financial advice. I'm merely sharing my experiences with you and hoping that it will help you. So, for context, I've worked in many different roles in various companies across different industries, some within investments and mostly outside. So, I've worked in audit, property, investments, slightly, and in consulting, SMEs, and startups. My career has generally mostly been outside of the investment industry, but with some stints inside the investment industry. So then you may ask, ways, what qualifies you to have this conversation? Well, I'm invested in local stocks, physical property, international stocks, listed property, venture capital, international property, and cryptocurrencies, and even impact farming. So I've tried my hand at the various things and I want to share some of my learnings. So you might ask at the beginning, ways, where do I start? I don't know where to start. And my answer would be put your own money on the line. That's probably a good place to start. Investment games, these online investment games, they help, but your emotions are very different when it's your money on the line. It doesn't have to be a lot of money, but it has to be your money. But even before you start, you must be interested in investing. If you're not interested in investing, then you're going to lose money because it's going to become a chore. Rather get a financial advisor and let them invest on your behalf, because if you're not interested, you're not going to put the effort in to learn. So I enjoy investing. It's a bit of a game for me. I have fun with it. And similarly, you must be willing to learn. I learn every day. I listen to podcasts about business. I listen to podcasts about startups. I listen to podcasts about investments. Some learn by reading. I learn by listening. So if you find out the way that you learn best, go with that. In general, you are not likely to do better than those who work in the investment industry every day because they have access to information faster than you do. This is especially true for day trading. You can still do well with long term investing, but day trading, you really need to be special to be able to do that and not be your full time job. And I think day to day trading is also something that you need the personality for. If you don't have the personality, you risk losing your hair and you risk checking your phone every 15 minutes, checking prices at work, which is not good for your job, what you're supposed to be doing. So when you start investing, decide what is your aim for that investment journey, or for that, even if it's for that specific investment. So, for example, are you trying to learn? Are you trying to let your wealth keep up with inflation? In the long term, are you trying to make generational wealth? And there's nothing wrong with the aim changing, but have an aim. Because if you don't have an aim, you end up just throwing your money at different things and hoping you get lucky and hoping you get rich. Something that's also important to learn is learn the different risks or the different risks at different types of investments and how they compare to each other. So, for example, venture capital, there's a different risk profile to investment property. Investment property pay rental every month. So it's a different risk profile to investment capital, investment or venture capital, where you put money in and you might only see that money in 5 years if you see it at all. Similar to cryptocurrency, so it has a different risk profile to bonds, as an example. Bonds might be safer. They pay the same amount of rate every month, but that rate never changes. So there's different risk profiles. Something else that you need to learn is if you can't stomach the price of your investment dropping, then maybe managing risky investments is not for you. Rather get into something safe. But that doesn't mean the first time it drops and now you're like, oh, I can't do this. You have to learn to do, because that's an emotional response. So you have to learn how your emotions respond to price changes. Just because the first time you decide to sell everything doesn't necessarily mean that investing is not for you. It just means that that's the first time you've dealt with it, so that's how you respond to it. If you're still doing those emotional responses by the 10th time, then yeah, okay, or the 5th time, okay, maybe investments are not for you, or managing your investments are not for you. And if you're starting with, let's say, a little amount of money, large returns are not going to make you wealthy. So let's say you put 100 Rand in, you get 100% return, you're going to get another 100 Rand, which is nice, but it's not going to get you anywhere. So it's not going to make you wealthy, but it'll help you to learn. I would say if you're starting with a little amount of money, find ways to make extra money first, whether that's a side hustle or something else, as a way to get more money and then invest a larger amount. But I mean, you can't go wrong from learning, from putting money in, even if it's excuse me, even if it's 100 Rand, 200 or 300 Rand. And luckily for you, there are always ways to start investing small. So I know easy equities, you can invest from as little as 300 Rand in stocks or in properties, or in which is fractional ownership of property. So when I started working, there wasn't those options of investing in such small amounts. So use the opportunities that are available to you. If there are any questions, I'll be responding to questions towards the end. Excuse me. So please add your questions to the comment section now so that I don't miss them. One important thing to remember is that investing is not a get rich quick scheme. Oh, that's a bit of a tongue twister. So it's not a get rich quick scheme. It takes time. I'm not talking months. I'm talking years. When I was younger, I used to think I could flip stocks in a few weeks, and what ends up happening is I end up losing money. In the long run, if you invest the right way, you can pay off big things. You can pay off bonds. You can pay off cars if you're successful, and that's something worth learning about and worth striving towards. Paying off big things, or investing in bigger things, or upgrading your lifestyle. Having a tax-free investment account will help as well, because that just limits the tax leakage that can happen from an investment. Just whatever you do, don't put your tax-free investment in a bank that just earns interest, because you're already getting an interest deduction from SARS, so there's no point in doing those. Another thing that, especially if you're investing in stocks, even if you're just investing in an investment property, I say even, but it's also if you're investing in an investment property, learn to understand how that business makes money, because every share on the stock market has a business behind it. The underlying business drives the value of the share. It's not just prices on a chart. Like if the business is doing well, that will reflect in the share. So business is not expected to do well. That will reflect in the share. So try to understand how the business makes money. Also try to understand the macro environment that you're investing in. So that means the global economy, or the economy of the region that the company is that you're investing in, or the business that you're investing in. Things like recessions, excuse me, lockdowns, wars, boycotts, all have impact. It doesn't matter how good the business is or how good any business is. If customers don't have money because of a recession, they can't buy from your business, from that business. If there's a war happening where the business is, or even if there's a war happening where your business normally buys their raw materials from. So you could be in the US, or you could be in South Africa, or you could be in a place where there's no war, but the raw materials that you need to get might be from a place that's currently being blockaded or something to that effect. Your business won't be able to produce any stock, so you won't be able to sell products. So don't just understand the place where the business is in, understand the place where the business gets their supplies from, or the raw materials from. Also remember to let your money reflect your values. You might ask, what do I mean by that? So, if equality and transformation is something that's important to you, put your money in organizations that make it a priority. If the environment is something that's important to you, put your money in the companies that focus on not necessarily focus on the environment, but it's an important thing to you. So, for example, in a listed company, they have what's called an integrated report, and they have in that integrated report they have an ESG, which is an environmental, social, and governance report, where they talk about how they are impacting the environment on a passive or from a not a negative, but how the business impacts the environment and how the business takes decisions to improve the environment. And that's also how the business takes decisions to improve the communities that are around them. So let your money reflect your values. Don't just say, oh, I'm going to invest in the cheapest opportunity, or I'm going to, yes, that might help you in the short run, but if an investment aligns with your values, that's a long-term investment worth having. So that's something to think about. In closing, I want to leave you with one message. Remember, this is your life. You are responsible for it. If you want to succeed, it's on you. I mean, you can blame other people for you not succeeding. You can say, that guy from LinkedIn or that guy from YouTube told me the wrong thing. But the only person that it's going to negatively affect is you. So take charge of your growth. Take charge of your life. Remember that the final decision is always yours. Even if you make the wrong decision, you can learn from it and you can change your decision and you can still succeed. This has been another session, and it has been live on YouTube and should be available on podcast by tomorrow. If you're watching on YouTube or listening on the podcast and you feel that it's added value, don't forget to like, subscribe, and click on that notification bell. Please also share it with someone you think it would add value to. Thank you for joining me for another episode of Two Ways to Skin a Cat. Goodbye.